Today we'll do a review of asset markets over 2024. "2024 has been a strong year for multi-asset investors, and if we break it down into the three main components for investors, which are equities, fixed income and currencies, we can do a review of each of those components and look at the returns that they have generated and what they've provided for multi-asset investors. So if we start with equities first, they've been the main driver of performance for investors. Global equities over the year had very strong performance, up 18%. However, if we break those down into the individual regions and look how they've performed, the US equities were the strongest over the year. They've delivered a return near 25% over the year. What has helped US equities has been the performance of the tech sector. And you'll hear us speak about the Magnificent Seven. Those stocks have delivered a return of nearly 50% over the year. So they've really boosted returns in the US from those tech-like companies. Second, behind the US was Japanese equities. They were up 22% during the year. And they really benefited from what had happened earlier in the year with corporate reform, with the stock market trying to boost the ROE of Japanese companies. Further behind was the UK, Europe, and emerging markets. They've suffered from weaker growth outcomes relative to the US, but the returns were still positive for the year, up 10%. So all equities, all the major regions in equities have delivered positive returns. If we look at fixed income next, fixed income markets had delivered negative returns from sovereign bonds and also investment grade credit. And that's because of what we've seen with interest rates. So despite central banks cutting interest rates, it's more about what investors are expecting going forward that impacts the returns on those instruments. And as we know, in December and in Q4, we've seen better growth outcomes in the US, and that's caused investors to push back the number of interest rate cuts expected out of those instruments. However, what we would note is that when we moved into that Q4 period, we have noticed that the correlation between equities and fixed income instruments has moved lower. So that means that they do have positive utility for investors for a diversification benefit. So there is a reason to hold them for multi-asset investors. If we finally move into currencies, we know that the US dollar has been stronger relative to sterling, and that's because of the better growth outcomes that we've seen within the US. If we look at sterling relative to the euro and Japanese yen, sterling has actually gained on those currencies, and that's due to the expected interest rate differentials between those regions. Now, what can we expect for 2025? Starting with equities, markets are still expecting positive returns from US equities. And what we know is that that's mainly going to have to come from earnings growth because of how high multiples are within equities. And we'll know a further update on US corporate health in the next 2 weeks when we see the start of earnings seasons. Within fixed income, we can see that markets are expecting 1 to 2 rate cuts in the US, 2 in the UK, and 4 in Europe. So please keep an eye on our YouTube channel for further updates. Throughout the week, we have some inflation data, some activity data, and on Friday, we'll have the US employment data. So some important data for markets. So keep an eye on our YouTube channel to be updated on those.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.